Welcome back, everyone. Hey, Nick. Hey, Alan. Hey, Justin. We had Inman day 2 this morning. A lot to unpack, a few themes to touch on. So let's get right into it. There were a lot of things talked about, ranging from brokerage models to technology to the state of the market, and most importantly, what agents need to be doing more of now to succeed. Let's start with, just like yesterday, the state of the market. And maybe this is a question for Alan, since you had a lot of insight yesterday around how over the past 8 recessions, only 2 have actually impacted the real estate market. One notable comment from the sessions this morning was that if you look at pricing and volume today, it is actually up compared to 2019. We had a very peculiar last 2 years, driven by shelter in place and COVID. I think you mentioned this, where you couldn't even show homes for several months. Then what happened? Real estate became an essential service. The PED form was invented for the COVID waiver, and all of a sudden, Matterport adoption went through the roof and people were showing homes. So while there might be a decline from 2021, if you zoom out and look at a trend line over a longer period of time, we are still higher than we were in 2019. And I think the other thing people are talking a lot about is what's happening in the stock market. And just doing quick view at some historical trends, the S&P 500 on August 4th, 2019 was at 2,900. Today it's at 4,100. So despite all of the volatility we've seen since earlier this year, both pricing is up, volume is up, the stock market up. Why do you think people are so spooked, Alan? What do you think is causing the root fear and uncertainty in the market right now?
I think everybody's just taking a bit of a pause. I also question, perhaps it's just me, but literally everybody I know has either just come back from Europe, is on their way to Europe, or are in Europe. And I'm really wondering how many people really have taken the time, and especially the agents, they're getting a break from a market that they've just been running at full speed for 10 years. The clients finally now could travel overseas with their families and not worry about it. So perhaps a lot of this pause is just summer and a lot of people being out of town. But again, I think what's important is that we don't relate the word recession with property values coming down. They're not equal. One does not lead to the other. And I think that was a real important takeaway that I got at the time, that recession is a way the government is using things to curb inflation. We can't continue inflation of where we're at. Otherwise, it would be absolutely impossible to sustain those levels. So really, when you look at recession and when your clients say to you, how is the market, you really need to start to qualify these things and let them know that recession does not equate to a loss in value in residential real estate.
That's super insightful. And on the topic of inflation, one of the key inflation measures is the rental index. And I think one of the things that's been happening, certainly in New York, is because of, to some degree, a change in interest rates, although we saw today that the 30-year mortgage rate is now at 4.99%. So we're now below 5%, down from the May peak of almost 6%. So I think despite 2 consecutive 75 basis point rate increases from the Fed, you are beginning to see a real fall in mortgage rates. But that aside, a bit of a rise in mortgage rates compared to the beginning of the year, and also inventory challenges have caused a lot of people who were maybe thinking about buying right now to shift towards renting. And as a result, rental prices in the rental market has gone absolutely crazy. Do you think that this is something that agents should just expect in the next 12 to 18 months, that, even though people can buy, there might be more of an interest to wait and see and continue to rent? Or in some cases, is renting more affordable than buying, just given the relative value capture? What are your general thoughts on that?
I think the rental market will increase based on all those factors that you just mentioned. But one thing to keep in mind, when they're quoting mortgage rates, they're quoting the mortgage rates on conforming loans, which is $649,000 or less. The interest rates on jumbo loans is actually less than the interest rates on conforming loans. So a lot of times when we're talking with our clients, we have to let them know that the media is jumping on these higher interest rates because it sells their newspapers. But the reality is, when we look at the jumbo loans, which really affect most of our clients, the rates aren't going up that high. The reason why the rates on the conforming loans are going high is because all those mortgages are sold on the secondary market to Fannie Mae and Freddie Mac, and they're controlling those interest rates. So that's why the conforming loans are a little bit higher. So you really have to dissect those interest rates when the media starts to give us those interest rates.
Very good point. We are seeing jumbo loans in the 4s and lots of adjustable rate mortgages that are even being priced in the 3s. And so you're totally right. And in our segment of the market, where the typical client is financing their purchase, that does fall into jumbo loan category. Let's talk a little bit about, we talk about pricing. I think what we just discussed speaks to the relative pricing impacts that this has on consumers to either buy or rent or sell. Let's talk about volume a little bit. We are underbuilt in the United States. There are not enough homes to support all those that need homes, and the rate of building over the last decade is not sufficient to keep up. So we're kind of in this moment where there is a structural bid ask between the demand and the supply. But zooming in more to our markets, we are starting to see, I think, a bit of inventory loosen up. And this is a question really for anyone, whether San Francisco for Justin or you and Nick for LA. What are you seeing with inventory, and does that inventory movement vary or differ at different price points right now?
Well, I think I can speak for the Bay Area and San Francisco. If you look at South of Market, which is really the only neighborhood really zoned for high-rise living and new development, you're going to have kind of more lofts, kind of excess inventory automatically because you have these high rises with hundreds of units. A lot of those are sitting on the market. They're ironically really easy to rent. They're renting right away, but it's very spotty. Some are selling, and for the most part, a lot of it is sitting. Whereas if you look at the rest of the city, where it's just constrained, limited inventory, whether it's Pacific Heights, Noe Valley, Ashbury Heights, places are still, going for premium dollar and pretty much selling right away, unless they have flaws like something like no parking or maybe on a super busy street. 6 months ago, a busy street wouldn't have mattered as much. It would have sold right away. So those things are definitely more of a concern. But, again, outside of SoMa, where there's just an excess amount of units that are basically all the same, the rest of the city is still moving really fast.
You want me to jump in now for Southern California?
Yes, I did kind of want to add that in Palm Springs, we're finding that there is still quite a bit of movement in the Palm Springs market, and it's a secondary market. Prices are a little different, but between the $2 to $3 million price range, we're finding that there's really not a lot of inventory. So the market, and that's a secondary market, so it's still pretty strong there in the secondary market.
I think in what we've seen in Los Angeles is that when you look at the quality of the inventory, I think that's part of the equation as well, because done homes are now still in demand. Properties that need work are not going to be as attractive. Justin talks about the busy street. Yeah, those kinds of factors that weigh into a buying decision become more pronounced. I will add one thing in terms of pricing and why I think pricing is checking back, and I think it relates to the stock market. So much of the down payments of buyers has been tied to the stock market, and when the stock market has gotten depressed, a lot of that value has been taken away. It's paper value, but if people are looking at that as their down payments, and then with interest rates going up, those that need to qualify and they need reserves, that starts to play into what we're seeing with pricing. But I think we're in one of the most healthy markets we've ever been in, because we are so underpinned with equity in these homes. And because there still is a relative constraint to supply, it's keeping those prices steady. So in terms of what our volume is going to be, Al touched on it at a recent office meeting in LA. We're going to start to see more inventory coming out in September. Wait till fall, I think, plays into that equation as well. So again, I just go back to that. What I see is a very healthy market. I see as a very opportunistic market. And I think when people do come back from their holidays and those people just have a moment to catch their breath, we are going to see volumes tick up, and I think prices will stay very stable.
Let's hope so. That's great. Shifting gears a little bit. So another big theme from this morning and really from yesterday was around the adoption of technology. And that's a big topic that we could talk for a very long time about, given our focus on technology at Avenue 8. But I think one way to thread the needle between this earlier conversation around the market dynamics and then the role of technology, and really, again, to play off something that Justin said earlier about 6 months ago, living on a busy street didn't matter. Now it matters more. There was a reference today that for the agent experience, it's moved from a speed-based market to a skills-based market. So rather than homes selling themselves, and the role of the agent is really just to shepherd a process along that already has movement. Now there is much more requirement of agents to be expert tacticians, expert knowledge bases and centers for their clients, and trusted advisors to make deals happen, as opposed to helping deals that are already going to happen, maybe happen a little bit better. And so then let's talk about what that actually means. If it's not a speed-based market and it's a skills-based market, first question, and this isn't about technology yet, but what are the skills that are critical now to make this market move, to make deals happen? And that's a question for you, Nick.
Well, it starts with confidence. If I have confidence in my ability, I'm going to walk into a room and I'm going to negotiate more effectively on behalf of my client and on behalf of myself. So people haven't had to build up their skills. They haven't, their role models have been these TV shows where this is all you need to do. And now those that have taken the time or are going to realize they need to take the time to become proficient at the basics, contract understanding, contract leverage, the ability to present yourself well, the ability to understand the inventory and the markets, to be able to not only articulate a market, but articulate the strategic value of a piece of property relative to the marketplace around them. And so we need to become, dare I say, expert at our job. And I salivate at that opportunity. So that's been our whole mantra for the past 6 months.
Totally agree. And those are all critical skills, and those are skills that should exist with or without technology. Now, layering on the technology piece to it, technology is never going to solve a problem on its own, but it can certainly enhance and augment anyone's ability to complete something in a better, faster, smarter, more impactful way. And so I think we can all agree that there is that agents do not struggle with not enough technology available to them. It's quite the opposite. There is an overabundance of technology out in the market, and choosing and vetting and actually using that technology is a barrier. It's our perspective at Avenue 8 that the role of the brokerage is to make that as simple and straightforward as possible. It is the job for the brokerage to be an elite identifier, an integrator of technology, whether that is technology that we build, that we borrow, or that we buy. In that lens, I think it all starts with, well, how do you use technology to activate the people you already know? There's a statistic that, Nick, you always talk about. 80% of an agent's business will come from people that they already know. And the best way to stay on top of those relationships is by leveraging a CRM, whatever that CRM might be. And this is a question for anyone on the call. Why do you think it is that there is a adoption gap for agents to really lean in and using CRM technologies?
I'm going to go last on this one.
Great.
I think a lot of it is time, just the time to set it up and the time to maintain it. And they don't realize how that time that they'll put in to create it and maintain it will come back to them tenfold, but it's not an immediate return. And I think that's where a lot of agents get discouraged.
Just to add, I think a lot of agents who, and we're talking more successful agents who are really great agents, they're focused and they're busy on the handful of clients that they're working on at any given time. And they honestly, it's again, comes down to time. Like Alan just said, they just don't get around to sitting and focusing on something that doesn't have an immediate benefit because you're too consumed with the handful of clients that they have at hand. It goes back to what I said yesterday too, which is, whatever work you do now as an agent, you end up seeing the effects of, 3 to 6 months later. So if you don't invest in the stuff that doesn't immediately give benefits now, you will end up feeling that effect later.
Someone said to me early on in my career, you can't afford not to have an assistant, because if you don't have an assistant, you're the assistant. And you look at the scope of the business that we have to do and all the different touch points and levels of sophistication we need to be consummate professionals. If you don't invest in your business, and one of the investments is a CRM or some way to stay engaged with your clients, so that then technology creates greater efficiency and greater leverage so that you can focus on more of the things that you want to do. That, early on, Al used to ask me, what's the thing you hate most about this business? And someone would say, I hate putting out the signs. I can't stand putting out signs, but the signs are a necessary evil to promote direction to the property and brand awareness, right? So there was a company brilliantly created a sign company, and they would do the signs for you. You paid them $40, and that was taken off your plate. So if you don't want to do technology yourself, hire someone, take 50% of your next commission and dedicate it towards streamlining your operation so that you then can step into the CRM because it's been done for you. Then you're that much further along. But we must invest in our business, and the experts and those that are prolific, they've got systems in place and someone does it for them. Until you get to that point, you got to do it for yourself or pay the money to do it, but you got to have a CRM or something that keeps you top of mind with your clients.
Totally agree, and I would say echo the view that you're not going to see an immediate result from a CRM, but you're 100% going to see no result if you don't do it at all. So better to try than not. That being said, I think there are ways technology can create more of an immediate impact, and I think it goes back to something earlier, Nick, that you said around. What is a key skill in this market that you have to hone? And you said confidence. What makes someone confident? Part of it is their innate, personality, but a lot of it is just feeling prepared. It is going into the meeting with specific knowledge and insight, and not just winging it. And that kind of goes back to a theme we were talking about yesterday, which is have the data at your hands, know the market. Don't just, I think you said, Nick, don't just know any market, know this market. So let's talk about that a little bit. There's a lot of technology out there, some of which we've built at Avenue 8, our tool, which is called Market Comp, which is an incredibly powerful and easy way to run a CMA. Just talk about, Alan, the importance of when you're having a conversation, whether it's your current client, a prospective client, the agent on the other side of the transaction, just how impactful having a mastery of the data can give you an advantage in those conversations.
Well, the numbers don't lie. So when you're very well prepared and you've got your numbers in front of you, you know what price per square foot is sold, you know within how much of the asking price have properties sold at, you know how many properties have transferred hands within the last 6 months in that neighborhood. You're so armed with those statistics that those will support your argument. And the numbers don't lie, and it's really impossible for somebody to refute the numbers when you understand the numbers and taken enough time to really explore and understand what's going on. So preparation on the numbers, it's all about that, quite frankly.
Definitely agree. And in a market like today, where you're seeing so much change happen, not even on a quarterly basis, but on a week-to-week basis, how would you adapt your valuation or data analysis strategy? I mean, looking at year-over-year comps of properties that were sold, or even 6 months ago versus today, might tell you something, but it may not tell you the right thing. So there's obviously both an art and a science to this practice. And this is a question really for anyone. How do you approach in such a fast changing, volatile market? How do you make sure that the data insights that you are capturing are enough for you to present in front of a client?
Well, I will just say before anything that this is why it's so important to get a really good real estate agent, because of these nuances. You could take San Francisco and just say, well, across the board, things are slower, but that's including, again, Soma, specific district where things are sitting when everything else is still selling fast. A good agent is going to know, well, this neighborhood is really hot in Napa, but this street is super busy, so this is now decreased in value. You're going to get a better deal here, whereas the other stuff is still going. So it again goes back to there's so many nuances in residential real estate, and this is why you can't just look at numbers. A lot of it is talking to a really good agent.
I would say that more than ever, the relationship between the columns, the statistical lines of active, pending, looking for backup, and sold now tell a very different story. I'll let Al talk about his strategy about pricing relative to actives, but look at it from if the numbers don't lie and you know how to interpret those numbers. When there was 2 properties for sale, there were 6 things in the different courses of escrow and 5 things that had sold in the last 90 days. You can easily tell what the market is, but now reverse that. Let's say there are 10 things on the market, 2 things are in stages of pending, and 3 things have sold in the last 90 days. Tells you a completely different story. Your ability to analyze those lanes and articulate how that depicts what the velocity of a market is makes you an incredibly valuable resource to a client's decision-making process. So understanding that relationship of those different categories is really of paramount importance. But I defer to Al to how he prices relative to actives.
Well, whenever I'm in a market where the prices are changing relatively quickly, besides for looking at historical comps to determine the value, I then want to look at what are the actives, what's the competition, what is the buyer going to be seeing? And so then we're going to price the property somewhere, a combination between what the historical comps are pointing us to and what our competition is doing at that same time. So I think it needs to be looked at both ways. Now, your bank appraisers are only going to look at historical stuff, but I think it's really important that you also look to see what's available and what's active when you're trying to price something in a market that's either escalating up or escalating down.
That's a great point. And I think in some ways that process might be more manageable today than it was last year. Last year, you had scenarios all across the country, but certainly in markets in California and New York, where whatever the list price was, the ultimate purchase price was sort of arbitrarily or irrationally driven by a bidding war, where there was so much money flowing, really given the low interest rate environment, that 30, 40, 50% over asking was not uncommon. And actually, one of our agent teams in Northern California just set a record for a home going $2 million over asking. Fortunately, they were representing the listing and not the buyer in that transaction. But in today's market, where you do have a cooling and a bit more of a normalization, I think you're totally right. There is a better way to approximate where something might trade at, given the historicals and then the things that are currently active on the market. Going back to the trend of CRM, and I think it has been proven time and time again that most of your business is going to come from people that you already know. But if you're newer to this business, the people you already know might not be that many. And so it is a very important part of the business to get yourself out there and to be noticed. And that's a question of marketing. And I think that's where technology has become truly impactful, both in terms of the speed at which marketing content can be created and deployed, and then also a lot of the science around how to use, whether it's your commission check, whether it's something else, use capital to accelerate the promotion of those materials in social media, in email, in display ads, in other channels where consumers are spending their time. And I know that, Nick, this is something that you have talked a lot about, sort of the importance of an agent having an integrated approach to that. What do you, similar question to why is CRM adoption not what it ought to be? Why do you feel that agents don't take advantage as much as they could of all of these different types of marketing dynamics?
The candid answer is they're lazy. I mean, if you want to make $250,000 a year, you can chart your course by the number of deals you sell, the average dollar volume of each deal. You go be a doctor, go to school for all of those years to make that same $250,000. We have a glorious opportunity. And I think so often, and this has been my challenge recently that I've put to our agents, is your time is yours. How effectively do you use it? Those of you that have a true fire in your belly to win and realize that you're at your job right now, and how would you hire you? I mean, based on the effort you put in this day, would you have a job? If someone was looking at you and says, I'm your boss, I don't know. So you don't need a lot of technology. You need to put yourself out there. And when I consider what the borrowed cool, the leverage any agent at our company or at any company can do, is if someone has got a beautiful listing, you as the agent with that company would say, snap a shot, do a social media post, put it out to your sphere of influence. Oh my God, I'm at one of our listings, our Avenue 8 listings. You get that leverage because you're associated with that. People start to think, wow, Nick's killing it. Look at all these properties that he's seeing it. He's busy. Yes, that's the perception that I want you to have. Not that I'm working on my golf game or I show my workout videos. I mean, come on, let's apply it to the matter at hand. So I can go on a soapbox, so I'll shut up now.
Oh, I'll just add on, with the technology, I mean, the ability to, go on Tuesday or Wednesday caravan/brokers tour, go in the best listings, give video tours, on social media of that. And you'll immediately, your contact and sphere of influence on social media, they're going to equate you with real estate when they think about real estate. That's what you want. Likewise, you can also do, videos of yourself where you're talking on the market, what's happening in Q2, how it's changed from Q1. Become that expert, and you could put that out on social and actually do ads. I know an agent who's fairly new who does that all the time, and he's blasting these out, and I'm getting like ads of this, and you kind of want to watch it a few seconds because he comes up with a catchy title. And these are really good ways to put yourself out there when you don't have a huge sphere yourself, and you want to be known for doing real estate and being an expert.
All right. Well, thanks, guys. That was great. A lot of good knowledge and wisdom shared. And for those of you that were tuning in the audience, thank you for joining. Today's the final day of Inman. We don't expect any more bombshell revelations out of the groups, but if there are, we'll be sure to cover it. Thanks for watching, and we'll talk to you soon.